Well, joining me now to break down the numbers is Gareth, Head of Australian Economics at Commonwealth Bank. Gareth, thanks for your time today. Quarterly growth of 0.9%. How strong is that performance?
G'day, Ed. Look, it was a strong outcome. It was very much in line with what the market was expecting, very similar to what we were expecting as well. And I've got to say, I agree with the Treasurer's sentiments there that there are a lot of headwinds ahead. You know, it's interesting, normally if you get a set of numbers like today, the Treasurer would be out there saying what a good picture it is. And it's definitely, if you just take a literal read of the accounts, it says things were very strong in the June quarter. But what the national accounts today don't pick up really is the Reserve Bank's interest rate tightening. And I think as we move forward from here, the higher interest rates are going to weigh on a material proportion of households. That will see a slowdown in spending. And I don't think we'll see the kind of numbers repeated again like we got out today.
Yeah, consumer spending obviously really underpinning the result today and those high commodity prices. So how much of that spending do you expect is now going to start tapering off now that the Reserve Bank has lifted interest rates pretty aggressively over the last 5 months?
Yeah, look, our internal data at Commonwealth Bank, which is more timely than the official data, suggests that spending flatlined over August in nominal terms. So given we've got inflation, that actually implies that the volume of spending has come off a little bit. Now, the extent to which it comes off further from here will be heavily dictated by what the Reserve Bank does. And I think all economists at the moment are struggling in terms of forecasting the economy because the economic outcomes that we get will be very conditional on how high the RBA takes the cash rate. And we don't know how high they're actually going to take the cash rate. They've put through a lot of tightening in a very short amount of time. There's an expectation they'll continue to raise the cash rate. And there's a lagged impact between when the cash rate changes and when there's a cash flow impact for home borrowers. And for CBA customers, on average, it's about 3 months. So the RBA is really front-loading the chamber here, putting a lot of tightening through that's yet to hit households. And I think as it does hit households, you'll see for a decent chunk of those households that they'll have to modify their spending accordingly. And I think the risk here is just that the Reserve Bank over-tightens in a bid to slow the economy down. They're flying blind to some extent because they're not able to actually see the data that's picking up the hikes. And there's a risk, I think, they end up taking the policy rate too high and actually the economy starts to go backwards. I'll flag that that's a risk at the moment. It's not our base case. But given how quickly they're putting these hikes through, I think we need to be cognizant of that risk.
Yeah, the other thing we saw in the numbers today was the household savings ratio falling. So is that also a clear sign of inflation and rising costs starting to bite Australian bank accounts?
Look, the household savings ratio was at an elevated level, and part of that was because of lockdown, so we just couldn't spend the way we would have. And the other part of it was that household income actually stepped up by more than it would have otherwise because the government stimulus was more than offsetting lost wages and salaries when people were in lockdown. So the savings ratio was always going to come down. It's currently at a bit higher than where it was averaging pre-pandemic, but it will come down further from here because the interest cost on debt will go up very significantly given how quickly the RBA has put the rate hikes through and given the percentage change in the mortgage rate is very large. And that'll actually drop the savings rate. So I think you'll see it come down over coming quarters. It won't necessarily be a sign that households are actually out there spending more. What it will be picking up is the fact that the interest cost on debt has gone up. That's an expense for a household and that drags the savings ratio down.
So is this June quarter the last good, strong quarter of economic growth we're going to see in Australia? Is it all going to be downhill from here over the next couple of years?
Look, I wouldn't say, well, it'll be downhill from a growth rate perspective. I think the 0.9% real GDP that we got today on the quarter is the high point and things will moderate from here. The important thing is, though, that we don't want to see a negative print. I think if we see small positive prints, it means the economy is still moving forward. It'll probably mean the unemployment rate ticks up a little bit, but it is at a very low level. What we don't want to see, though, is negative GDP, because if we see that, it means the economy is contracting. And if the economy is contracting, given we'll have pretty decent population growth now that the borders are reopened, it means that too many people will be losing their job. And that's not something the RBA wants. So to the point I sort of mentioned earlier, really the outcomes we get from here will be heavily dependent on what they do. And ultimately, there's a lagged impact between what they do and when we see it in the official figures around GDP. So Q3 will still be positive, a smaller positive than 0.9. I think those growth rates will further moderate. The risk is, though, that we get a negative print. If it turns out to be the case, the RBA is taking the cash rate too high and too many households put the brake on spending, given how important household expenditure is for the national economy.
Gareth, we've got about 40 seconds left, but the RBA Governor, Philip Lowe, he's speaking tomorrow. What are you hoping to hear from him?
Well, I think what I'm hoping to hear is what a lot of households, Australian households and businesses are hoping to hear is some clues on when they're going to pause in the tightening cycle, because they've been moving in 50 basis point increments. A lot of households are pretty anxious out there about where things are going. So I think any forward guidance on what the tightening cycle looks like from here, whether they intend or not to keep putting through with 50 basis point hikes, and any sense of when they might pause, given the lagged impact of those hikes on the economy. That's what I'll be looking out to hear tomorrow.
Oh, well, Gareth Ed, Head of Australian Economics at CBA, thanks for your time today.
Cheers, Ed.